Are you thinking about purchasing a new home soon? Hold fast. Do not sign that paperwork until you've heard about what's in this video. Hey guys, thank you for joining us on Living and Buying in Charlotte, North Carolina. I'm Keith Porter, and I'm joined today by my new friend, Darius. Would you like to introduce yourself?
Sure. Thanks for the opportunity, Keith. Darius Bryant. I'm a loan officer with CMG Home Loans, and I am excited to be talking about the all-in-one loan. It's going to be real. This segment's going to be really informative and beneficial.
All right, so just as an intro to this, let me tell you, I was sitting around the table with Darius and a few realtors the other day, and he brought this up, and none of them had heard about this. And I started looking into it and realized it's something that a lot of consumers don't know about, and people in the industry. So I was lucky to have Darius agree to jump in with us, and he's going to educate us. And, you know, as a teacher, I love education. So thank you for joining us.
Yep. Absolutely.
All right, so before we jump into this, I want to give you a scenario. Okay? Let's say a few years ago, I took advantage of COVID, right? I locked in that record-breaking 2.7% interest rate. Like, I'm ecstatic. And I'm like, I'm never going to beat this. And now interest rates are what? Like 6% up there. We're at 7%. Like, I'm afraid to do anything. So let's say I'm that person. I have a mortgage on my home, and I also have a line of credit. So I'm currently paying interest on both these loans separately, and my monthly payments are now becoming a burden. Also, there's some other expenses coming up, you know, a lot of stuff going on. Got to do some stuff in the house. And then time goes so fast. My kid is going to college, so I need to pay for college and renovate the home at the same time. So in this scenario, what options currently are available to me? If you were any other lender, what would you throw at me?
Yep. So let's talk about what you actually have. You have a mortgage and you have a home equity line of credit. The mortgage is in the first lien position. A home equity line of credit is going to act like a credit card. The method of repayment of the debt on the mortgage, no matter what the interest rate is that beautiful 2.75. The method of repayment of that debt is on an amortized schedule. By definition, an amortization schedule shows what's being applied to principal and interest over a term. 30 years if it's a mortgage. That's the typical, 99% of the time you're going to get a 30-year mortgage.
And that's how we do it.
Yeah, that's how. What it also is, it's a massive delay on repaying the debt that you actually owe. People like myself, before I really understood about this loan product, I wanted to know what my interest rate is. I wanted to know what closing costs were, maybe at best what my APR is. That's what a lot of savvy buyers or borrowers are going to want to know. Here with this, with amortization, if you were to ever to look at your amortized schedule, which is part of your loan closing documents, you would be shocked to see how much of your mortgage payment is actually going toward the principal.
So let's say I have, let's make it easy. Let's say a $300,000 house. Is that easy enough?
That's easy enough.
And I have a 30-year rate, let's say 3%, okay? What would be the estimated principal payoff in that first month?
Probably less than $100. For all of those people out there that are in a mortgage and you have access to your closing docs, go ahead and look at your amortized schedule and see how much of that first mortgage payment actually went to principal and how much of it was just interest only.
So hold on, that $300,000 house, my payment's probably somewhere between $1,200 and $1,500, right? You're saying less than $100 of that $1,200 to $1,500 is going to the actual house?
Probably within that first month, absolutely.
Well, where does the rest of it go?
That the banks are happy for your mortgage payment because that is interest up front. And here's some other statistics. I mean, and when you look at when people actually refinance their house, that's done within the first 5 years of home ownership. Now, regardless of the benefit, it's a lower payment, we could save more money monthly, that's a real benefit. But it's such an overwhelming win for the bank because you're resetting the interest payments from zero all over again because you're getting a brand new loan. So while mortgage debt or mortgages, it's highly recycled, banks are happy to do it because it resets the clock on the interest payments.
You know, and I just thought they really liked my business. Like, I get that call as soon as it's getting close, and they're like, "Hey, would you like a better rate?" I'm like, "Of course I would love a better rate."
Yeah, and banks are happy. You want to refinance? Cash out or just rate and term, we're happy to do it. It's a brand new loan, and you're going to pay less per month, but you're also going to pay nothing but resetting the clock on those interest payments all over again. And hence where the all-in-one comes in. It's a principal paid first model. The interest is calculated second. It's the one loan that actually separates the principal and interest. Every traditional loan, principal and interest payments are combined. The genius about this loan, it separates it, which means that you're going to save money over time in interest costs because you have a principal reduction from day one.
So the best way that you explained it to me the other day whenever we were talking about it, you said that a normal loan is interest first, principal second. That's what we're thinking about. Mm-hmm. Now with this one, you said it flips that, and it is...
Yep. So the way that it works, it's called the all-in-one loan because it combines your personal banking and your home financing into one account. So when someone makes a deposit into their all-in-one bank account, it's a fully FDIC-insured bank account. Checking, savings, bill pay, mobile bill pay, all of that, you have all of that accessibility and functionality. Whatever deposit is made into the all-in-one account, at 12 a.m. midnight of that night, it turns into a principal reduction to the loan. So for example, if you have household income of $7,000, say $7,000 is deposited into the all-in-one account. At midnight, you have a $7,000 principal reduction to your loan. But you've got to get gas, you got to buy groceries, you have to live life. You can access, you haven't lost the ability to use that money. You could spend, let's say you average $3,000 a month just in spending. So you have a net $4,000 principal reduction to your loan in that 1 month.
So basically, I don't have to make a separate payment. My direct deposit does my mortgage payment for me in this case.
Your direct deposit, any idle cash, money you find on the sidewalk, you deposit it into your bank account. Whatever that amount is, it is a principal reduction. And the beauty, because there's no forward amortization in this loan, you're not going to get a bill saying your mortgage payment of X, $1,200 or whatever it is due on the 1st. So it has such flexibility if an emergency happens. Hey, I have to pay for my car, or God forbid, my income just got cut in half. Well, you can make a smaller deposit. It still counts as a principal reduction. In a traditional model, that's a fixed payment that's due. And you sometimes will have to make payment arrangements with the bank, maybe forbearance, try to move some payments to the end so you got some time to make sure you're not late on your mortgage. Because there's no forward amortization, you're not going to get that pressure. So if you have a cut in income, you make a smaller deposit. And it gives you time to recoup and get your income going where it was.
I mean, that sounds like a better program just in itself, because it's embarrassing to, like, we get it in our head that we're supposed to be in control of our finances. So when we have to make that call to the bank, say, hey, like, something happened, like, we get embarrassed.
Yeah, it's embarrassing. And then, you're always walking on eggshells, like, okay, how's this going to affect my credit? That's the biggest thing, because if it affects the credit, then your ability to even refinance or even do other things becomes limited. So this allows you such flexibility without having to notify the bank. You can make a smaller deposit, and it's fine. And it's fine. There's no forward amortization in this loan. So that's one of the safety features people with a traditional loan, they do not have. In the event tragedy strikes, there's a cut in income, or emergency happens where you have to spend money and it affects the budget.
Now, I'm a numbers guy, okay? So I just want to circle back here. You said that original scenario where we had a $300,000 house that first month, maybe $100 goes down to principal. So I owe $299,900 after that first month. Now with this, $7,000 to the principal. If I have $7,000 hit and I don't spend anything out of it, like that's $7,000 that went off the. That's, I mean, under the other program, it would take me like 6 years to make that much, right?
100%. We have an all-in-one calculator. It's public. You can go to the website and play around with this thing, and it gives you a side-by-side comparison of an all-in-one pay-down schedule versus a fully amortized 30-year loan. And you could see how much money you're going to save in interest cost because you're paying principal first. And the principal paid first model, the interest is being calculated on a principal loan amount that's decreasing month by month. So that principal payment, or the interest cost payment, is going to go down with the principal reduction each month. So I love this loan because, one, since CMG has been doing this since 2005, there's not been one default on this loan.
Okay, well, since you're talking about interest, how did they figure that then? I mean, because if it's not set in stone, like, how do I know what my interest payment's going to be?
So it's a daily interest calculation, and you can Google daily interest calculation just to see what that is. It is the rate times the loan amount divided by 365. And on the 26th of every month in your all-in-one loan, that interest payment will sweep. It basically pays the bank. So there's no escrow in the loan. So it's in terms of paying for your homeowner's insurance and property taxes. I personally pay that right out of my home equity line of credit. I wrote a check paying off my insurance in December, so it's not included in the mortgage payment, which is principal, interest, taxes, and insurance. Here in this loan, I just pay principal and interest. The principal payment is my deposits driving it down. The interest is the daily interest calculation, and on the 26th of every month, that amount sweeps out of the account. And for taxes and insurance, I pay that. I just write a check right out of the equity of the home to pay it off.
And because it's a daily calculation, then the more principal that's paid down, the less interest that is paid during the month. So that's how it's paid off quicker then, right?
100%.
This is fantastic. So, and you already said I can pay other bills out of this. Like, it's like a bank account then.
Yes, it's designed for that type of lifestyle. Hey, my groceries, my gas, whatever you spend from your home equity line of credit, it's not from your bank account. The loan amount will go up accordingly. So if you deposit $7,000 on a $300,000 loan amount, let's say, that deposit that is a principal reduction. Your new loan amount is $293,000. If you spend an additional $3,000, that's okay. That loan amount will go up accordingly, but the following month you're going to have another principal reduction. So it's designed for you to pay bills, get groceries, basically live life. And like I said, with the flexibility of having no amortization, if something comes up, you can always add that, go to your home equity line of credit. If you need to pay off some bills, you can write a check to do that. It just has a lot of safety features, I find, as compared to a traditional loan you just won't have.
So I'm thinking through this, and like, you got money coming in, money coming out. It sounds like you can get a little bit confusing. Like, how do you know when it's paid off?
So when your loan is paid off, right? So let's say if you have $300,000 loan amount, and let's say over the course of 10 years, that $300,000 is satisfied. You now have an option. You can call the bank and say, hey, I'd like the title deed. I see my loan is paid off. Great. Your home is now paid off. The loan portion of your bank account goes away. You have a checking and savings account. Or most people, they keep the equity available. So the interest stops sweeping over. The interest calculation stops sweeping if the loan amount is paid off. But now you've got a safety account. Go on vacation with it. Spend $10,000, pay off a bill. Whether it's a student loan, there's no stipulation on how you use the money. And whatever money you use, the method of repayment is the same. Your deposits drive down the balance, and there's still that interest calculation. So you can keep that loan amount active. The interest will stop once it's paid off. Like I said, you have those two options. Now, this is an important thing to mention about the all-in-one. There's no forward amortization. At the 10th year in this loan, whatever your loan amount is, it will begin to decrease by a factor over 1 over 240. Because the 240
is 20 years.
But in 20 years. So you'll see a gradual decrease. So at the end of year 30, it's zeroed out. But you can keep that open, whatever it is, whatever that amount is. That could be a good retirement account. It could be a good, hey, we're just going to keep it there just for an emergency account if something comes up. You can't do that in a traditional loan. Once it's paid off, it's paid off. Here you have the option, do I want to access the equity of my house for the rest, for 20 more years? Or, hey, I've got good cash flow, let's just stop it, get the title deed, and be done.
Well, see, we know that with a traditional loan, I can access the equity. I just have to do like a cash out refinance. So what's the difference between that process and then this here?
Great question. So in that situation, if you've got a good amount of equity in your house, which most people do, a lot of people are sitting on a large amount of money right now. But in order to do a cash-out refinance, it's just that. It's a refinance where you're going to be resetting the interest payments again, whether it's 10, 15, 20, or 30 years. Now you have already given yourself the method of repayment that is delaying the principal reduction on your house because you're paying nothing but interest up front. So even in a 15-year model, right, if you refinance into it, you're going to have a pretty large mortgage payment paying that back. Not everyone can do that, but even in that instance, there's no great principal reduction. You'll be paying more towards the principal in a 30-year. But that sometimes for most people causes for a change in budgeting lifestyle. Here you can pay that house off just as fast, if not faster, without changing your budget. But in order to answer your question, sorry, I get excited about this. The refinance is giving you a brand new loan. And in that brand new loan is a brand new amortized schedule. So my thing is, why do that if you could pay the house off just as fast by paying the principal first and the interest calculated second?
So just to clarify, in a traditional loan, I have to go through a whole new process of like a credit check, like closing costs, income verification to get it. Under this program, I have access to it already.
You have access. You will never have to do a cash-out refinance to access the equity in your home.
Now, would I be able to refinance under the all-in-one loan, like if it's a different rate?
Sure, you could. So, you mean refinance to an all-in-one loan product to a different all-in-one loan?
Well, yeah, like like if the rate that I have for my all-in-one is higher than the current market rate, like could I refinance still?
I do not believe that you can. That's an interesting question. I'm going to say no, but I'll get back to you on that because the all-in-one has some features that you can get into. You can start off month to month as an ARM, and people get nervous when I say ARM.
I just got to chill.
Yeah. You know what? There's no. The numbers don't lie, and that's why that's the good thing about numbers. You could be concerned about an ARM loan if you're an amortized schedule, but when you're in a loan that the principal is being reduced with every month and the interest is calculated second, you'll see that even if the ARM at the fully indexed rate, you're going to pay your house off faster. And many times when I do an illustration, I'll give them the worst case scenario of a fully indexed rate in an ARM and how you could still pay your house off faster than an amortized schedule. And if you don't want to do the month to month, we have fixed rate products. So for someone that's like, hey, I'm so conditioned that ARMs are bad, it's okay. We have fixed rates that we could put you in and at least get you on the path of paying your house off faster without you being so nervous that it's an ARM product.
So it sounds like you have options when you speak to your lender about this, okay? So, I mean, that just sounds so exciting. Like, who would you say this is most useful for?
That's a great question. This product is most useful for someone who is cash flow positive. So you'll see the most results where people aren't spending more than they make, even if they've got the credit score, even if they've got the assets. If there is a trend of, hey, they spend every penny that they make.
The race to zero, I call it.
Yeah. I would say you want some financial discipline, but you don't have to be. It's not a matter of I don't make a lot of money. It's relative. It's how much money do you have left over after you spend, after your monthly expenditures. When you look at that, the first all-in-one loan that I did, the loan amount was under $170,000, and they're going to pay that house off in 5 years. It's a low loan amount. The income from the couple, they make enough money where they will own that house outright. I think it was like 7 years. 7 years. So as opposed to 30, and even though that's a low loan amount, you can go. It doesn't matter. It just is for people that's cash flow positive.
And this isn't just something that you're pushing. Like you have one of these.
I have this loan. When I understood it, and we were talking about this earlier. Amortization. It's a shame there's no new innovative ways to repay mortgage debt. The rest of the world has it. It's called an offset mortgage. This is not a new loan product globally. The rest of the world is actually using a product like this. So it's when I really understood it, I was like, wow. We're so conditioned just for a low interest rate. What do we want? I want a low interest rate. I don't want to pay a lot of money on closing costs. Can you do it? And if we can, we're happy. And so are the banks, because they know statistically you're going to refinance with a brand new loan, paying them nothing but interest up front, and you're probably going to sell that house in 10 years. And then you're going to do it all over again with another bank. So for people to know about this loan, to see how it can fast forward them into true home ownership and never having to refinance to get access to the equity, okay, take that money and invest in an asset, whether it's real estate, your own business, that's your decision. But at least we could show you, in my opinion, the best way to get to that without having to sacrifice paying your house off slower.
This almost sounds like a no-brainer. And again, I was blown away that the other realtors around me had never heard about this. So let me ask you, as a lender, why aren't banks pushing this?
My speculation is one. It's more of an equitable win for everyone, and I think banks are in a place where they're winning overwhelmingly. So it would have to be kind of a step back for them, in that they're kind of just allowing everyone to benefit more. So I don't want to say, because I still do amortized loans, and if we can get someone in a low interest rate, that's still good, because they can live in a house within their budget. But it's a shame that since 1938, the way banks lent money has never changed in the United States. It's never changed, and that's the Great Depression era. You have companies like Japan, India, Australia, Western Europe. They use this type of loan. So I'm a little bit critical to the industry as to why we haven't come up with better ways to lend to the American people, right? And because in the face of this, I'm like, this works. Now, can everyone qualify for it? Probably not. But if they can get into a house, you can let them know about this. And it's possible that their first refinance could be into a product like this. It's going to help them. It's a less risk factor for the bank. Since 2005, since CMG Home Loans has been doing this, to date, there's not been one default on the loan. So that's a risk.
It seems like a positive, like a pro.
Yeah. So to answer that question, why aren't banks doing it? Maybe because they don't know about it, or choose not to know about it because they really like how the system is working now.
So you touched on it here a second ago. So let's circle back. What are the requirements for this loan? If I say, I'm sold, I want to do this today, Darius.
Yep. So if it's for a primary residence, you'll need a 700 credit score minimum and at least 10% of liquidity, 10% of liquid cash of that loan amount. So if it's a $300,000 loan amount, you need $30,000 liquid somewhere. Bank account, a retirement account that's accessible. It's got to be liquid, and it can add up to it. So that's one. If it's an investment, it's a 725 credit score and at least 15% liquidity of whatever the loan amount is. So that's the two big ones. Other than that, that's pretty much it. Is in terms of the requirements for the loan.
Now, you spoke about investments, so I'm going to ask a question about that isn't on my sheet. So okay. Let's say I am an investor, and I love this loan, and I purchase a house using this loan. Could I pull money from that loan to invest in a second property?
Absolutely. Absolutely. There's no stipulation on how you spend that money. You can pay off bills. I really like it when an investor wants to put it into another property. The good thing about it, they're going to access the equity of the home that they own, put it into another property, and whoever's in that house, their payments are principal reduction, repaying back the money faster than it would be in a traditional HELOC, which works like a credit card. This, because there's no forward amortization, that rent payment, you can decide how much, as the owner, you want the principal reduction to be. So you can pay your house off faster. And but yes, 100%, you can access the equity of the house, use it for another one.
So I could live in one, rent another out, and suddenly have renters paying for both for me.
Yeah.
That sounds like a pretty good deal for an investor, let alone a homeowner.
It is. I closed an all-in-one deal. This was some months ago, and when I told the person about this, they had just closed on their loan, and they had only made one mortgage payment. The reason why they went with the all-in-one was because there was a real possibility that they were going to move to another state because of the wife's job. So they were concerned, like, how much money am I going to make? Could I profit in the all-in-one loan versus the traditional loan that they had? So I told them, I said, you're going to make more money in the all-in-one loan because you're not just relying on the market in terms of how much your house is appreciated in value. Because in a traditional loan, unless you're going to put extra money on the payment, you're not really going to have that principal reduction. In this loan, you'll make more money if you sell in 7 years because you'll have paid down the principal more. So when I explained that to them and they kind of just saw it based on their finances, how much they could reduce their principal amount, it was a no-brainer. So now if they do sell in 6 or 7 years, they'll make more money in that transaction than if they were in just a regular traditional loan. They would only be the value that they could get, or the equity that they would get, is based on how fast that home appreciated in value for that market. And it's different in other places for that particular market. So I said, when they saw the principal reduction feature, the light bulb went off and I was able to win that loan.
I feel like we could talk for hours on this one.
We can.
Is there anything that you haven't said that is just like off the cuff, like on your heart, that you need people to know about?
We touched about this before we turned on the camera. I feel like now understanding this loan product, understanding it, having it for myself, every person needs to look at this thing. A lot of people in this country, we're in inflation, and people are sitting on a lot of equity in their house, and it's a frustrating position to be in because how do you access that? Especially if they bought a house within the last 3 years. They've got a great interest rate. They really don't want to sacrifice that by refinancing or having to move, because depending on the area, they may have to even downsize in the house because the prices have increased so much. So here is a loan product that has the potential. In this inflationary market, you can refinance into it and potentially pay off your house faster than if you sat and stayed in the traditional low interest rate that you have, the low interest rate mortgage that you have, and you can access the equity. Now you can pay off that student loan. Now you can invest in an asset, whether it's buying an investment property or your own business. I always say how you invest is up to you, but we can give you a loan product that will give people the opportunity to access cash to get ahead in this time of inflation. And I don't know of another loan product where you can refinance right now and potentially be in a better position to pay the house off faster and never have to do a cash out refinance. I love this country. I think with the stresses that we're all feeling from the market, this is a type of loan that gives us the ability to choose what we want to do and to really get ahead.
You know, and with everything else going on right now too, like for those people who either did get in the low interest rate or haven't right now, and it's actually a good market for an ARM loan, right? Because, yeah. And just in case you're watching this and you don't know what an ARM loan is, I'm going to show you what I've learned so far, okay? You tell me if I'm wrong. ARM is adjustable rate mortgage, and a traditional one could be 3-1, 5-1, 7-1, 10-1, right? Right? Which tells you how many years you have a fixed rate, and then after that, it fluctuates with the market. So could go up, could go down, but we are in high rate right now. So the potential is that at the end of that ARM period, it could go down. How'd I do?
Yep, 100%. That's great. That's great.
So it's right now with the high interest rate, we're shouldn't be as afraid of an ARM loan, and
No.
so it actually puts us in a position where this could be.
So even with an ARM loan, I look at it like this: we have higher rates, let's say, for sure, than the last several years. I have a retired couple. They're closing this month in an all-in-one. They're selling their house. They're putting 80% down on the new house. They're going to move. So you have an 80%. They're putting. They're putting $80,000 towards the new house. The rest of the proceeds that they get from the sale of their house, I told them don't put it in the loan. Wait till you close, and then you move that money into your all-in-one account. You're going to have a $100,000 principal loan reduction. So they went from a $300,000 loan amount to a $180,000 principal reduction. The $80,000 in their down payment and the $100K, which they'll have access to if they need it. That money's not gone. That's the beauty about the loan. So they'll move that money over. If you did it with any traditional loan, that $100K, the bank is going to take it. You can't touch it. It's gone. Here, move it over. Let it be a principal reduction to your loan. And if something comes up where you need to access $50,000, go back to it and use it. I've never seen a loan like this.
And it seems like people need to see loans like this. So why don't you do a quick plug if people want to know about this? How can they get a hold of you?
Oh, my goodness. You can go contact me. My mobile number is 732-977-8167. Call me. You can ask me questions. My email address is dbryant@cmgfi.com. And if you want to look at my page, it's dariusbryant.com. That will take you to my page. You could access the calculator from that page and play around with the numbers for yourself. But I'm always happy to answer questions about this loan. I'm very passionate about it, and I think it's a lot of benefit for people.
Thank you. And guys, I'm doing you a favor right now. I'm going to cut this shorter than we could go right now because I want you to ask those questions that you want. But I hope you got a lot out of this. I certainly did. I listened to him talk about it the other day, and we talked about it quite a bit before we pressed record, and I still learned a lot about it while he was talking. So there's a lot to learn about this loan. It sounds amazing. Don't be stuck in what we've always done. Look at other options, and this is a perfect one if you have the financial discipline, the 700 credit score, and the ability to get up to 10% down. Which, by the way, in case you're not a numbers person, that is half of the 20% we're used to looking for.
That's right.
So thanks for joining us today. I hope you got a lot out of it. Till next time. Wow.
Yeah.
I'm gonna have to edit that part.
That's all right, man. I'm so excited, man. I can't tell you. This is the first time, and I knew if the more you talk about it, it'll connect with people because this is a game changer. What it did for me, for someone with variable income, and we have, by the way, we've got video testimonies of people that are in the all-in-one, that have got it, and people with variable income because they're in sales, what it does for them. There's actually one we have on site, a real estate agent in South Carolina, that it's a beautiful story. But I feel that this is for the people, for anyone who could benefit. And if you're like, hey, Darius, I'm not there, that's fine. We can show you how to get there. 2 years, 3 years is going to go by no matter what. And just with a little changes in the budget, you should be able to get there. And this can put you in a position to get ahead in real estate, pay off debt, financial independence. It really gives you control that you will not get in a traditional loan. So I'm so glad that you did this, man. I can't tell you. We're both excited. And yeah, this is a game changer.
Look, if you're excited too, if you got some good information out of this, go ahead and click subscribe and like below. If you want to ask any questions, you can put it in the comments below or reach out to Darius or myself. If you reach out to me, I'll get you in touch with them. Until next time, thanks for joining us on Living and Buying in Charlotte, North Carolina.